Welcome to The Explainer. Let's just dive straight into something that pretty much terrifies all of us, the inevitable stock market crash. Look, if you are investing your hard-earned money for the long haul, you are absolutely going to face some stomach-turning drops. It's a complete guarantee, but today, we're going to completely reframe how you look at market crashes so you can actually survive them. 14. Yeah, you heard that right, 14. If you have a standard 50-year investing horizon, say from the time you get your first real job in your 20s to the time you finally retire in your 70s, you can expect to live through roughly 14 different bear markets, 14 distinct times where the market broadly collapses. So I've got to ask you directly, when you inevitably hit those 14 crashes, are you going to panic and lose it all, or are you going to use them to actually get wealthy? Because the difference between those two outcomes entirely depends on how you behave when the red arrows start flashing everywhere. And to survive those scary drops without panicking, we first really need to understand the beast we're dealing with.
Section 1, Bulls and Bears Explained.
You know, Wall Street loves its fancy jargon to make investing sound way more complicated than it is. But honestly, it all boils down to one magic number: 20%. A bull market simply means the broader stock market has gained 20% from its most recent low. Things are charging ahead, right? A bear market just means the market has dropped 20% from its recent peak. It's hibernating, dragging downwards. That is literally the entire technical definition.
But underneath all that math, it's really just a story about human emotion. The legendary investor Sir John Templeton famously said, "Bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria." What's so powerful about this quote is that it reveals how market cycles aren't just random lines on a screen. They're a reflection of mass human psychology. It's this endless pendulum swinging back and forth from paralyzing fear to blind euphoric greed.
Section 2. The 2000 dot-com bubble. Real American stakes.
To really picture what that market euphoria looks like right before a crash, we just have to look back at the absolute mania of the 2000 dot-com bubble. Back in the late 90s, if you just slapped a .com onto your company's name, investors literally threw money at you. We had companies operating at massive net losses, throwing lavish million-dollar parties just to generate buzz. The whole market embraced this terrifying growth over profits mentality. And when that bubble violently burst in March of 2000, the NASDAQ fell by more than 75%. Over $5 trillion of wealth was completely wiped out.
The real-world stakes here were just staggering. Take Pets.com. They're basically the poster child for this despair. They had a $300 million market cap, and it plummeted to absolute zero in under a year. Just gone. But then look at Amazon. Amazon was a victim of the exact same crash. Their stock dropped from a bubble peak of around $100 all the way down to just $7. $7! But they survived, stayed the course, and rebounded spectacularly. Could you imagine holding that stock when it crashed from 100 down to 7? Your stomach would be in absolute knots.
Section 3. The 4 market stages.
So, why do we go from lavish parties to complete financial ruin? Well, it's because market crashes aren't just random. They actually follow a highly predictable step-by-step cycle. First, we have discovery. The market is quiet, the smart money sniffs out an emerging trend and quietly buys in. Second is momentum. This is where awareness grows, the general public joins in, and FOMO totally takes over. This is what leads to that euphoric blow-off phase we saw in the dot-com era. Third, we hit the transition. Skepticism creeps in, creating this massive push-pull between buyers and sellers. And finally, stage 4, deflation. Panic selling, capitulation, and total despair set in as prices fall rapidly.
Section 4. Biggest beginner investing mistakes.
That deflation stage? That is exactly where people completely destroy their wealth. And the absolute biggest rookie mistake is letting your fight or flight response trick you into thinking you can time the market. You think, oh, I'll just sell my stocks right now and buy them back at the very bottom. But here's what most people don't know. You can't. Warren Buffett hit the nail on the head when he said, the only value of stock forecasters is to make fortune tellers look good. Nobody, and I mean nobody, can accurately time the market's ups and downs.
And here is a seriously mind-blowing data point that proves exactly why trying to time the market is a terrible idea. 42%. 42% of the S&P 500's absolute strongest, highest-gaining market days over the last 20 years actually occurred right in the middle of a bear market. Think about that for a second. The days where the market surges the most, the days that truly build your long-term wealth, they happen while everyone else is panicking and the market is officially down. So the absolutely crucial point is this. The best way to weather a downturn is simply to stay invested. If you let fear win and you sell your stocks, you are going to miss those sudden, massive recovery days. And missing just a handful of the market's best days can absolutely devastate your long-term returns.
Section 5. The ultimate market takeaway.
All right, so we know crashes happen, and we know we shouldn't sell. But here is the single most powerful insight that will cure your fear of the next stock market crash. On average, a bear market, all that pain, panic, and deflation, it lasts about 9.6 months. But an average bull market, it lasts 2.7 years. The bulls run far, far longer than the bears hibernate. And hey, it's not just the duration, it's the magnitude. The average bear market brings a painful loss of about 35%. But the average bull market, it brings massive historical gains of 112%. Yes, for sure, that 35% drop hurts. It triggers all our human survival instincts. But that pain is entirely dwarfed by the massive, compounding 112% gains of the ensuing bull markets.
Which brings us to this incredibly reassuring visual trend. Look at this beautiful, jagged saw blade spanning from 1936 all the way to 2022. Up close, yeah, it looks terrifying, full of sharp drops, recessions, and crashes. But zoom out, and what do you see? A distinct, undeniable upward trend. Historically, the market rises on 53.6% of trading days. Over time, human innovation just continuously pushes company earnings higher.
So knowing that the math is heavily rigged in your favor over the long term, are you really going to let the next inevitable bump in the road steal your financial future? Stay the course. Don't panic. If you found this explainer helpful, make sure to subscribe and watch our next explainer to keep mastering your money. See you next time.